third and last panel for the day, which is called Innovation and Sustainability in Banking. We have our panelists already lined up. So thank you so much. We will be talking about some of the sustainability-related emerging themes of today and the future, some of which are risk-based green supporting factor versus a brown penalty, ESG, role of banks in financing the transition to a 2-degree economy, climate risk management models, green lending, digital, AI, fintech, regtech, and all the other themes that we've been listening in the past. Let me just tell you that the fintech funding grew from 82% from 2017 to 2018, which brings it really to the forefront of these discussions. We've heard recently from the Vice President of the Euro and the Social Dialogues, Financial Stability and Financial Services, Vladis Dombrovskis. He said that we are looking positively at the European Parliament's proposal to amend capital charges for banks to boost green investment and loans by introducing a so-called green supporting factor. On the other hand, we've had representatives from the Finance Watch, and they have stated that such a factor would do very little to the environment and would leave the banking system even weaker. They say that evidence suggests that large changes to the risk weights would be needed to have any effect on the lending decisions by the bank. There's also been a study by McKinsey that proposes 6 imperatives to banks that they need to undertake to really survive this situation. And what they really said is that the first initiative is the innovative new products by banks, to lock in the shift to the digital sales and the services and reshape the physical distribution, meaning to focus more online on AI and mobile banking, to create a structurally leaner and a scalable cost base, which means that most of them would need to improve the cost basis by, as they estimate, 25 to 35%, to reset the organization and technology for speed, where they say 50 to 65% on average, retail banks' workforce could be redeployed, 10 to 40% could remain off premises more permanently. Point 5, to double down the risk in the capital management, and 6, to rebalance the business mix and seek targeted M&A deals going into the future. So to kick off this discussion, I'd like to bring Mr. Jonas Jansen, who is a senior economist at Copenhagen Economics, our second representative from this institution today. Very happy to see you with us here. He's specialized in financial economics, has led the work on various projects with capital marketing, regulation, and sustainability, both for public shareholders and stakeholders, for the European Commission and the private customers. Prior to Copenhagen Economics, he worked as a civil servant in the Danish Ministry of Finance with economic impact assessment, and holds a degree from University of Copenhagen. Mr. Jensen, how do you see the risk-based green supporting factor, and how do you assess its, I would say, introduction or enforcement may impact the banking industry? Do you agree with what the Finance Watch are saying, or are you more in favor of its introduction?
Yes, thank you very much. Can you see the slide that I'm presenting now?
Yes, we can see and hear everything perfectly.
That sounds good. I'm sorry, I didn't actually catch everything that Finance Watch were mentioning earlier. There was a bit issue with the sound as well. But yes, I will talk a bit about this debate on a green supporting factor and whether and how green assets should be treated from a regulatory perspective. Let me first just come with a disclaimer that this is indeed early days in terms of how to handle credit risk of green assets. And this is a project that we have just started at Copenhagen Economics, and we will look into this for the next coming year, where we have devoted a substantial amount of research to exactly this topic. So what I'll present today are sort of hypotheses, ideas. I'll try to ask the right questions that we will then address the coming year. Of course, also building on top of the increasing amount of literature there is on this topic. So specifically, I will talk about regulation of green assets from a banking perspective, and where we are using energy efficient mortgages as a case. So mortgages for energy efficient renovations. Let me just quickly sort of state the challenge. We have the Paris Agreement. We know we have a target of carbon neutrality in 2050. Obviously, that requires a transformation of our economies. It requires electrification of the entire economy, massive expansion of renewables, and it requires investments in energy efficiency. We have made some estimations that on an EU level, there could be a need of a total of 3,500 billion euros of investments to be compliant with the Paris Agreement. So there's a massive challenge. And that is, of course, also a massive challenge for the financial sector that eventually, one way or another, will have to finance the majorities of these investments. So this is indeed an important question, and the financial sector has a key role in green transition. Put it another way, if there is not the financial sector does not participate in the green transition, it's very difficult to see how the green transition can be realized. So this is indeed a important question. Try to change slide. Yes. So what is this talk about a green supporting factor? Well, I think the motivation for even having this discussion is quite straight ahead. It's quite clear. Policymakers, they want to incentivize green investments. You want to complete the green transformation, and obviously you want to give any kind of an incentive you can to make green investments. So therefore, of course, there is also talk about, can we, from a regulatory perspective, from the banking sector, actually incentivize green investments? The idea being that, well, if we have a green supporting factor in regulation of green assets, for example, lower capital requirements for green assets, that will mean that banks have lower costs of financing green investments. When banks have lower costs, they will pass on these costs to customers. So it will be cheaper to lend for making green renovations, and therefore there is an incentive to make more green investments. So I think the idea behind the green supporting factor is clear. Now, that's the reason why we're even having this discussion. Does it then make sense from a risk perspective? I think there is the debate on green supporting factor is not really settled yet. I see there are two fundamental approaches to this. One way is just to say that, well, from a political perspective, we like green, so we want to support it. So we just say that green assets now have lower capital requirements. I think this approach might be a dangerous approach. I think it might contradict the normal financial stability goals we have of prudential regulation. Just because that an asset is green per se does not mean that it's more robust towards credit risk. You must remember that we do have capital requirements to guard against financial stability issues and to guard against a new financial crisis. So just from a pure political perspective to say, well, we want to give lower capital requirements for green because we like green assets, is a bit of saying that in the Tesla, you don't need an airbag because the Tesla is green. Well, this is not really the issue we're trying to address. We're trying to address another issue. So I think you need to be really careful about your argumentation that, well, capital requirements is to handle credit risk and to handle financial risk. And so if we are to include a green supporting factor, from my perspective, it has to be from a risk perspective. It has to be there are some entailed lower risk in green assets that can be addressed, and therefore we should have maybe lower capital requirements. So this is what we are going to explore and will be exploring the next year. And what I present to you in a moment is sort of hypotheses and ideas of how to go about that. That also means if you have any sort of questions or comments or ideas that you would like to raise, then please, either after this presentation or send the questions to me directly. I will be happy to discuss this. So just on a sort of a top line, why would green assets be less risky? Well, there are two fundamental approaches you can take. The first is what we call the present perspective, when we look today at green assets, are there reasons to believe that they might be less risky? And there are some aspects that point in that direction. We know on different assets that green assets has higher valuations. For example, we know that energy efficient buildings have a higher value. We made a study a few years back at Copenhagen Economics showing that every time you increase the energy efficient label one notch, for example, from label B to A, the value of a typical household increases with 1,000 euros. So we know that the collateral value increases when you have, for example, energy efficient assets. Now, that might already be included in the current credit risk framework to the extent that you actually have updated values correctly on your assets. But it's still an aspect where you can say this could call for lower capital requirements for green assets. The other perspective is a bit more troublesome because that's not within the usual credit risk framework. That is the forward-looking perspective. We know going forward that there are a lot of several transition risk. We know that that transition to a green economy entails the risk of stranded assets. That could be highly polluting assets. Of course, if you have a green asset, you have an energy efficient asset, there are less risk to these transition risks. There's less risk of being a stranded asset. So that should somehow also be included in the regulatory framework. And how that can be done on a banking perspective, there is a bit more early days still. This is still what we are looking into. So just to say, are green assets really less risky? There is already been done a lot of work in this field. A lot has been done on an investor perspective, where we have shown what is the risk for equity portfolios in a green transition. So one study by a UN-sponsored study called the Inevitable Policy Response said that there's a risk of equities declining globally on 5% due to transition risk. So sort of risk that is currently not priced into equities. There has not been done so much research yet on the banking side, especially not in terms of the forward-looking perspective. We have seen one study that has addressed it a bit, but there's no sort of concrete way to handle this yet. So that was sort of the overall framework. Let's now dig into the case that I suggested with energy efficient mortgages. So mortgages for renovations of buildings and mortgages to finance the purchase of energy efficient buildings. And use this as a case to see how can green assets being regulated. So again, first going to the current perspective, why would there be lower capital requirements for energy efficient mortgages? First of all, we know, as mentioned, that energy efficient buildings, they are worth more, they have higher value. Therefore, you have more collateral in terms of default. So that means that the technical expression loss giving default is lower. Simply, if a customer defaults, the loss to the bank is lower because the value of the home is higher. There's simply more collateral value. And that, everything else being equal, should entail lower risk for energy efficient mortgage. The second aspect that we need to look into is how the probability of default will be on these green mortgages. So what is simply the probability that a person with an energy efficient building defaults on the person's loan compared to in a normal household? We know with energy efficient buildings that the energy bill is lower. You simply pay less for heating up your home or cooling it down during summer. So after the energy bill has been paid, the disposable income is higher when you have an energy efficient building. That again should entail, everything else being equal, lower risk on green assets. So taking already now, not having any forward-looking perspective, just taking a current perspective, already now we have some concrete sort of hard facts why we would expect risk to be lower for green assets, and in this case for energy efficient mortgages. On top of that, we have what I mentioned earlier, there is the entire forward-looking perspective. Let's say we go into a scenario where there will be huge taxes on fossil fuels. There will be a large CO2 price. That means that all the buildings now that have heating based on fossil fuels, that could become immensely expensive to heat up. And that could entail a much larger risk. That also sometimes has to be incorporated in the current credit risk treatment of mortgages. So bottom line is there are aspects when looking at energy efficient mortgages that should entail lower risk. Lower risk should entail lower capital requirements, and that would give a lower interest rates to energy efficient mortgages. So as I mentioned, we already have, when we look at the current perspective, there are some aspects why we think there is lower risk. It's more troublesome to have the forward-looking perspective. How can we sort of simulate the fact that energy efficient mortgages and green assets are more robust to transition risk? This is of course a very important question, but also a difficult question to simulate, because it's a bit outside the usual sort of risk weight prudential framework. We can maybe look a bit at on the investor side that is a bit more sort of advanced in making scenario analysis. A typical way to accommodate transition risk is to look at a carbon price scenario. So simply assuming going forward that the carbon price will increase, and then see, given we have a carbon price, so simply a tax on CO2 emission, how would that impact the assets that we have? This is something that I've done for a lot of on the investor side, has been carried out in several papers. We could also do that on the banking side to see how would we expect mortgage assets to be impacted in such a carbon price scenario to sort of simulate these transition risks. And again, we actually come up with the same sort of impact. Well, in such a carbon price scenario in the future, if emission of CO2 becomes very expensive for various reasons, again, we would expect that to impact the loss given default. If you have a high carbon price, well, if you have an energy inefficient household, that could become that could decrease in value a lot, because no one wants to own an inefficient or energy inefficient household. And the same, in such a carbon price scenario, that could lead to exploding energy bills, significantly increase the probability of defaults. So the same sort of dynamics are at place also in a forward-looking perspective, again showing that everything else being equal, an energy efficient mortgage should have lower risk weights because they are lower entailed risk. So that brings me to the end of the presentation. I think in terms of looking at the current perspective, looking at current asset values, there are already tools out there to incorporate the sort of beneficial aspects of green assets into the regulatory framework. We don't need to invent anything new. It's just a matter of making sure that the lower LGD, the lower PD is sufficiently incorporated in the regulatory framework. That is something that banks could already start doing today. This is not in any way contradictory to the current credit risk framework. It's a bit different with the forward-looking perspective with the scenario analysis, that is something that maybe is more similar to the current stress test that banks are doing, but it's not something that is sort of formally included in the estimation of risk rates. So there, some work needs to be done, and further research has to be done. And as written here on the bottom of the page, we are looking into this. But also, if you have any ideas of how this could be done effectively, maybe also within the current framework, I will be very interesting to hear. And perhaps also some of the other panel participants have some good ideas on this, so I will for sure listen in on the next presentations. Thank you.
Thank you very much, Mr. Jensen. I'm sure there will be plenty of volunteers to join the work you're doing on this topic, and it's very interesting to see the fact that you've presented here. I just wanted to add on what you've just said. There are also indications, empirical implications or evidence that there is a positive correlation between investments that directly provide environmental benefits in their financial performance. One of the studies done by Hermes Investments was that they show that companies with a better ESG ratings usually have a lower credit default spreads, which kind of adds to the PD story that you've just discussed. And I think maybe if the 10 of us on this panel start with building homes that would be green, maybe we can improve banking sector at least by a little bit. Thank you so much for your input.
Just to raise that is in fact there are a lot of studies showing that the current sort of they have lower PDs, they have lower LGDs. The question is that already included now in the current credit risk framework, how these assets are being treated? Then we all already have a sort of a green supporting factor already included in our credit risk framework, simply because they are performing better. So that's it is very interesting to dig further into.
Correct. I'm sure the academic world will also be looking into this very closely in the years to come. I'd like to bring Mr. Jacob Thoma now, who is the Managing Director of the 2 Degrees Investing Initiative. He's a co-founder of this 2 Degrees Investing Network in New York and Berlin, and manages the think tank on the research of the 2 Degrees scenario analysis for financial institutions and companies. He led the development of the first 2 Degrees scenario analysis tool for financial portfolios, which is now being used by more than 250 financial institutions worldwide. In addition, he leads the organization's partnership with a number of financial supervisors, governments, including an academic advisor of the Bank of England. He holds a PhD in finance from the Conservatoire National des Arts et Métiers in Paris. And he also teaches the Green Finance course at the School of Orientation and African Studies, University of London. So it's interesting to see that even the academic world is now introducing green finance courses and green-based courses, which is, I think, a good start for this discussion. Mr. Thoma, there are thoughts that the green supporting factor we just discussed with Mr. Jensen, or the Brown penalty, would bring no benefit to the banking world. You have estimated in one of your papers that the effect is a reduction in the capital requirement associated with the green support factor of around 3 to 4 billion euros based on the baseline green definition. So can you tell us a little bit more about the study and what did you find in this battle, I would say, between green and brown?
Sure, absolutely. And it was great to hear your presentation, Jonas, about your thinking and the distinction between the risk and impact. Well, one of the challenges, as Jonas already highlighted, is the fact that it doesn't seem 100% clear what the underlying policy objective is of the green supporting factor. And without defining that policy objective, it becomes hard to assess the success of that policy intervention, because it's not clear what you're actually trying to go for. Are you trying to make financial markets more resilient, or are you trying to support a broader policy goal? Now, one of the things maybe where I would quibble with Jonas as we were looking through the analysis here is that we actually see we don't have such a strong track record of supervisors taking a view on what's more or less risky, right? They tend to be quite sensitive about that. They think that's the role of financial institutions. We do have supervisors if you will, changing the underlying objective of prudential frameworks for policy goals. Now, we may disagree with the fact that they're doing that, but there is history is littered with supervisors deciding to actually support policy objectives with that policy instrument, for better or worse. In Europe, we had the SME supporting factor in 2012, I believe, or 2014. In Basel, we have special carve-outs for trade export finance. We have some special carve-outs for infrastructure. We have some carve-outs, especially in emerging markets, in Bangladesh for green. So there is a track record for that. It's just that I think in our mainstream thinking, we don't consider that a good idea, right? And so the historical role models for interventions like that exist. It's just that we don't think that's the way the prudential framework should be used. Now, one of the things that was quite interesting to see as we looked through that is that the first aspect is there are quite a few studies about the potential effects, and there's reason to believe that a green supporting factor and a brown penalty, for that matter, would change cost of capital for companies. So we looked at companies in our analysis, not the mortgage sector so much, like highlighted. So there's some historical role models for that, but the data is quite uncertain. We don't have most of those role models are changes to capital requirement writ large rather than specific subsectors. So the incentive system is unclear. And the brown penalty factors are significantly larger. They create much larger capital effects because there's a larger universe of assets that are affected by a brown penalty than a green supporting factor, just because there are more brown, quote unquote, brown assets than there are green assets. So that's the first thing that we found. Now, the other thing that we found is that there may be a risk, given the oversubscription of green assets already in some segments of the market, like green bonds, that what that green supporting factor is actually doing is just piling more money into the same universe of assets, and that creates this green bubble dynamic, right? That we also highlighted, that Jonas also highlighted. So there is empirical evidence that there may be changes to cost of capital, but if supply is inelastic, so supply in the sense of green assets, because this has to get intermediated, you might see some bubble effects coming in as everyone is trying to pile into the same universe of green assets. And of course, part of those effects are also a function of the underlying resilience of the balance sheets. Well-capitalized banks are going to be less sensitive to those types of adjustments than undercapitalized banks. And then finally, so one of the things that I think is worth exploring is there's this new instrument that's getting increasing prominence, which is this concept of a transition bond or sustainability improvement loan, where the coupon payment is a function of the meeting of sustainability performance indicators. And so one way to potentially avoid this piling into a fixed universe of assets is to actually make the green supporting factor, quote unquote green supporting factor, not contingent on how green an asset is, but how much greener the asset is becoming over time. So if you take a mortgage, you're only getting that factor if you're greening the energy efficiency performance of that house over the duration of the mortgage or part of the duration of that mortgage. So lots more to say, but I know this is a sin of all panelists to get on too long, so I'll stop here.
Thank you, indeed. One more short question for you. There is this notion of the new stress testing paradigm around us, and analyzing the long-term, I would say, sustainability risks of such a practice that is being done almost all the time. In this whole green and brown story, how would you see stress testing being done going forward? Would it require certain adjustments as well, or would it stay being done the way it is now?
So from our perspective, sustainability stress testing, if you will, as a larger concept, is obviously an integral part of the interface of sustainability and finance. It's a way for us or for supervisors to understand the resilience of financial systems to sustainability issues. And it's also a way to understand the extent to which there might be elements of mispricing. So a subcomponent of the stress testing logic is to understand, is there capital misallocation that might come to haunt us down the line. Now, as we see this new field emerging, what is quite interesting is that new field is also challenging some of our traditional assumptions about stress testing. So we're really learning two lessons here. One is maybe there's a better way to do mainstream stress testing. That's one aspect we're learning. And the second aspect that we're learning is maybe we shouldn't, every time we see a new risk issue emerge, try to shoehorn it into stress testing as the tool. So there's both things happening at the same time. So I'll maybe just briefly give you an example for each of these, right? So if you take traditional stress testing, many of you here joining this conversation today will appreciate that, I'm sure. It's an incredibly cumbersome and expensive exercise, right? It's It's a huge amount of resource strain. It's very slow. It takes a year, sometimes more, to implement. It's in many cases, if you're on the supervisory side, doesn't necessarily yield this comparability that you're looking for because of the flexibility in the risk models, the lack of insights into the underlying data frameworks, and this type of thing. And so what's actually happening, quite interesting, on the sustainability stress testing side is ways to overcome that. So 2 examples is, first, this concept of bulk or centralized stress testing, where the supervisor is actually doing a climate stress test by sending the whole stress test software to the bank or the insurance company. I mean, instead of getting a description of the scenario, you're getting a whole software package, which allows you to run the stress test at minimal to no cost. So one example is in California. That was a stress test for 673 insurance companies. The total cost of that stress test, I would say, somewhere in the vicinity of 30 to 50,000 euro. So you can imagine you're essentially paying a couple €100 for stress testing an insurance company on climate. Totally different to the millions being spent right now in many financial institutions on the topic. Now, of course, there's engagement after that, but the actual raw analytical exercise becomes, the marginal cost of that becomes close to zero through this software solution. And I know we're going to be talking about AnaCredit later. Solvency II and AnaCredit data in Europe, to the extent that it exists, actually allows the supervisor to run the software in-house. They don't even have to send the software to the institution. And that software can be flexible and adaptable to allow the type of diversity of risk management approaches while still creating a comparability and articulation in the way this is implemented. So that's one example. Now, the other example is the need for potential snap stress tests. So we have COVID-19. This is a live situation. And the response by supervisors is, we're postponing the stress test. It's too long. It takes too long. So one of the things we've done actually with the European insurance supervisors, we ran a snap COVID-19 stress test. The turnaround of that stress test was 4 weeks, which means we were able to run a stress test on the European insurance sector, or I should say, to be precise, a scenario analysis using stress test scenarios, because obviously stress test is a sensitive word. In case anybody from IOPA is listening, it's not a stress test, it's a stress test scenario, over 4 weeks, right? So that is really something that gives you a live action shot of where markets are at, which institutions might be in trouble, get ahead of the the capitalization needs that might be coming down there. So those are things we're learning from sustainability stress testing. And on the other hand, what we're also learning is we need to think about these types of issues a little bit differently potentially. So when you take the COVID-19 crisis, this is what we might call an existential risk, right? So, or 1 in 1,000 risk. These types of risks that are secular, they are micro in nature, which means they don't cover pharmaceuticals benefit, other sectors suffer, right? Their time horizon is not intuitive, right? Sometimes they happen literally in the day, right? Sometimes when it comes to climate, these might be 15, 20-year trajectories, non-linear trajectories, right? Where over the next 5 years, we might see continued growth in fossil fuels and then a decline, right? How do you anticipate that? And so here, we need to think about new ways to both design it. So thinking about maybe delayed stress tests. One of the things we did with the Bank of England was run a 2030 climate stress test that only starts in 2030. But then also, obviously, the infrastructure to plug that information to make a decision useful. I mean, everyone is interested in doing essential risk management, but the critical question for supervisors, companies, and financial institutions is, how do you build resilience to something where the incentive is to get bailed out anyway when it happens? And if we're all going to die, then why bother preparing for it, right? So here we have a huge, right now, a lot of the attention is about how to design these scenarios. But the real challenge moving forward as we think about sustainability stress testing is taking those lessons back into the mainstream stress testing community, centralized bulk stress testing, these types of things, delayed scenarios, but then using sustainability stress testing to ask yourself the hard question: what are we going to do with those results? How are we going to actually action them? How are we going to do the arbitrage between the cost of holding more capital, the cost of being more resilient against sustainability risk versus the benefits? And these are really new questions where traditional models and traditional capital models and capital structure models are unlikely to tell us a lot, and where more work is needed.
Thank you, Dean. I think the good thing about conferences like this is that we are transmitting so many wonderful suggestions to the policymakers, to the managements of different institutions. I just hope that they'll be able to absorb all of this wonderful ideas coming from our panelists today. Thank you so much for the wonderful answers.
Can I say one more thing about that? Sorry.
Sure. Please go ahead.
I just want to, sometimes I think this is a great thing about conferences, but sometimes I think people also listen to conferences and think, okay, these are kind of pie in the sky ideas. What is he talking about? Centralized stress testing. But people should be aware that this is actually happening. So IOPA, the Japanese Financial Services Authority, which is a Japanese supervisor, they are running these types of analyses right now. So any supervisor, these things are accessible to any financial supervisor in the world to manage sustainability risk. They're not pie in the sky ideas. There are many unanswered questions, but any supervisor who wants to run a COVID-19 pandemic stress test or climate stress test can do that with the type of software that's being developed in the market. And that's minimal marginal cost to the supervisor. In some cases, even zero marginal cost, because these are tools that are accessible live effectively. So I just wanted to say that to avoid people thinking this is pie in the sky stuff.
It's really not. It's really not. And I'm sure that all of our audience is I would say, looking at the names and the lineup, is very high-level people from different institutions. And I'm sure they're very, stuck to their laptops now and computers, looking and listening to all of this great advice that we're getting from all the sites. We will be discussing Anacredit as you've announced, and all the other aspects of the sustainability and innovation in banking. We'll move on to our next panelist now. His name is Mr. Bill Harrington. He's a senior fellow at the Croatan Institute, an independent non-profit research institute whose mission is to harness the investment in a social good for ecological resilience by working at the critical axis where sustainability, finance, and economic development do intersect. Since 2011, Bill has a self-financed full-time advocacy to rectify the undercapitalization of the complex financial products that started and fueled the 2008 financial crisis. He has submitted technical comments to the US and the European regulators, legislative committees, and law enforcement agencies. Bill, I hope you can hear us.
Denis, I can hear you. Can you hear me?
Yes, we can hear you well. Bill, you claim that Fed has undermined the 2010 Dodd-Frank Financial Reform Act, which is a major reform Congress made in response to the great financial crisis, by fully relying on credit ratings, which we all witness provided to be misleading in many cases, in both 2001, where you mentioned Enron and WorldCom, and 2008 with the major financial crisis. What is your take on this, and can you give us some more on those thoughts, and how does the ECG feed into this whole story? So first, I'd like you to tell us a little bit about your views on these rating agencies and the outputs they produce. How does this feed into the ECG story?
Absolutely. I'm going to start by just giving a little bit more brief information on the institute where I'm a senior fellow, Croatan Institute. It's based in North Carolina in the United States. Croatan is a Native American name. It relates to some of the early European settlements in the United States. And following on the last comment, we are a very progressive institute within a progressive world, but we focus entirely on hands-on, doable things. Some of my colleagues work on racial equity, economic finance, and sustainability. Some work on place-based organic farming as a way of revitalizing local communities. And I have worked since 2011 after resigning from Moody's, and then from 2017 on, when joining Croatan, to work on the sustainability of the financial system itself. And what drove me to do this, which is very clearly the dishonest postmortem by what the credit rating companies, which in the U.S. are overseen by the SEC, and they're called nationally recognized statistical rating organizations. And 4 of these, DBRS Morningstar, Fitch Ratings, Moody's Investor Service, and S&P Global Ratings, are also part of the Eurosystem Credit Assessment Framework. Their methodologies, which determine how committees assign credit ratings, are demonstrably flawed. I can talk about this not because I talk to the credit rating analysts behind the scenes, it's because I read the methodology. I joined Moody's Investor Service in the derivatives group in 1999. I had previously been a derivatives trader at Merrill Lynch. And I worked in the derivatives group, which rates asset-backed securities, derivative product companies, collateralized loan obligations from 1999 until 2000. I can offer on a first-hand basis that the company, Moody's Investor Service, did not want to accept responsibility for what was wrong with the rating. I can discuss on a first-hand basis that subsequent to 2010, the SEC, the U.S. regulator, undid some of the most important Dodd-Frank regulations which might have imposed accountability on credit rating agencies. And a takeaway for everyone listening, whether it's sustainability or pure credit risk, is that anyone can try to influence the credit rating methodologies by critiquing them, by submitting critiques to the credit rating agency. This is underutilized and almost not utilized at all in the sustainability world. But for instance, listening to Mr. Jensen in the first talk, or Mayor Rodriguez-Valadares on the previous panel, to the extent that there's something about the credit rating methodology that is ignoring credit risk, a direct and actionable way to influence that is to submit a critique of the credit rating methodology and point out how the factors that you're concerned with influence an issuer ability to pay. A major problem in the sustainability world right now is that the credit ratings themselves do not map rigorously how either the allied products of the same firm, for instance, Moody's Investor Service and 427 are owned by Moody's Corporation. Moody's Investor Service also produces Moody's ESG factors, but the credit ratings from Moody's Investor Service, the ECAF, the NRS, or a credit rating company, does not map out how these factors are used in the credit rating themselves. And this basically allows the credit rating companies to ignore ESG risks as well as financial sustainability risks in assigning new ratings, but they have enough wiggle room that when there's an emergency such as the wildfires in California or Australia, potential water inundation, they can downgrade after the fact. And the big problem here is that these credit ratings are so demonstrably flawed that they're not providing good information on how either the U.S. or the EU or soon to be the UK, other places in the world, should direct investment flows going forward. Specifically, the point you raised, an external co-author, Joe Pimbley, and I wrote a Croatan view as part of the materials that people have, discussing exactly the fact that the Federal Reserve is explicitly relying or explicitly using credit ratings to determine eligibility for a range of the recovery programs. I think it defies common sense because the credit ratings are demonstrably wrong. I know it violates Dodd-Frank 939A, which directs all U.S. regulators to stop relying on credit ratings. And the Fed knows this because in the Croatan view, which any of you can look at, the link is to the Federal Reserve having published its compliance with Dodd-Frank 939A some years back. The best argument that I've heard for this is that it's just a way of having cover should something go wrong with the assets that are bought. To me, that's as bad as any other reason. The Federal Reserve should be taking responsibility for its lending decisions. The Federal Reserve has lots of credit rating analysts, and to the extent that, and I would argue it's very demonstrable, the credit ratings are flawed as well. This is the time to get rid of them, not the time to embed them into the financial system. So I'll stop there, Danita, see if you want to follow up on that.
Thank you indeed. I'd say that's a view that many people have been looking for, and to see, I would say, somebody come openly to discuss the potential issues of credit ratings that many institutions, not only Fed, are heavily relying on, especially in today's world where we see this transition, especially from the borderline investment grade ratings to the junk part, which according to the analysis that we have out now is going to be quite extensive, and it's going to impact the, I would say, balance sheets of many financial institutions out there. Thank you, Mr. Harrington, for this insight for now. We might have some questions for you from the audience towards the end as well. Now I'd like to introduce our next panelist. His name is Professor Armin Kamel. He's an interdisciplinary lawyer, scholar, and an experienced executive specialized in banking law, securities regulation, banking law, and financial markets. He holds degrees in both law and business administration from prestigious universities in his native Austria and abroad. He has more than 15 years of experience as an executive in the financial services industry, working as head of legal and international affairs with the Austrian Association of Investment Fund Management Companies and serving on the board of directors of both International Investment Funds Association and European Fund of Asset Management Association. Dr. Kamel, banking sector operates under this complex network of regulations, be it local standards, laws, international accounting standards, banking laws, antitrust laws, international taxation, anti-money laundering, and most lately, fintech regulated provisions. What do you see as the key regulatory challenges in such an environment for financial institutions going forward?
All right. First of all, thanks a lot for having me here. I hope you can hear me well and that you can also see me. I just want to bring first, as a typical lawyer, a disclaimer that I'm speaking here as a scholar, so not in any kind of other professional capacity, because the kind of introduction that you made was fairly extensive, and you also pointed out that I'm working as an executive in the industry. So my thoughts will be really with my scholarly hat on. And I have been asked to address some of the regulatory issues regarding fintechs. I think the composition of that panel is excellent, because clearly with the green finance discussion as well as the fintech discussion, you're definitely spot on the hottest topics these days. Leave aside, obviously, the challenges in relation to COVID-19. But by kind of focusing on the fintech discussion, I first wanted, in a kind of critical manner, lay out how to approach fintechs from a regulatory perspective. When we just start with the pure facts, then I think it cannot be neglected that the financial industry has always been at the forefront of technological innovation. Because when we just kind of witnessed the discussion about fintechs over the past couple of months and even years, there's always this kind of idea out there that fintech is something completely new. Well, it is to a certain extent, but nevertheless, I think we should not underestimate the innovative nature of the financial industry as a whole. And I'm here not kind of specifying the banking industry or capital markets, investment industry, etc. I think we see that both ends. So therefore, I think when recognizing that the financial industry has always been at the forefront of technological innovation, it always also becomes clear that there is something new out there, a kind of new market segment, which is the so-called fintech segment, which is a segment which clearly experienced a significant growth over the past couple of years. And this growth, obviously, like we are all perfectly aware of, triggered some regulatory concerns and regulatory actions. However, before we dig a little bit deeper into the technicalities here, I think it's important to kind of specify what we actually mean by a fintech. And typically, when also kind of reviewing literature, then fintech is mostly used as a kind of term which is kind of covering startups and new market entrants to the financial industry, which in principle, and just to make it as simple as possible, applies technology to finance. Well, obviously, this doesn't really help us a lot from a pure regulatory perspective, and hence we have also seen already some, I would say, attempts by regulatory and legislative bodies to kind of define fintechs. And the one that I currently like most is the definition by the FSB on fintech, which basically states, and I'm just quoting here, a fintech is technologically enabled innovation in financial services that could result in new business models, applications, processes, or products with an associated material effect on the provision of financial services. Why is that so important? Because it clearly stresses that we have here a new momentum, and we are not kind of exclusively referring to the technological drivers in the existing industry, and that we also have new market entrants here. And why is the aspect of the new market entrants so important? Because at the end of the day, the question is all about how to regulate this new market entrants. When we just view it from a pure regulatory perspective, then we clearly have a kind of discussion about risks and benefits of these new fintech entrants. However, before we kind of explore that a little bit further, we also have to be aware that what is understood as fintechs can basically be clustered into two categories. The first category is that some of the fintech activities are basically reconnecting new business aspects with some traditional, particularly banking patterns. That would be everything that is relating to payment services, mobile payments, digital wallets, and the like. But it can also be in the area of lending and financing, for example, crowdfunding or credit scoring. But I think what is also important to stress here is the second category is that certain fintech activities are really kind of linked to providing additional or new services. And that would clearly have to be linked to financial data management, artificial intelligence, cybersecurity, TLD, and the like. So when we kind of focus on both groups, then we do have to make a traditional benefits and risk assessment, and what are the, I guess, commonly known benefits that have always been stressed so far in the context of fintechs. Well, first of all, lower costs. Then the idea of financial inclusion, increased competition, more innovation, but also increased service quality, particularly also kind of pushing the traditional players to enhance their services. And to a certain extent, there are some arguments out there that fintech activities also lead to more diversification in the financial industry. On the other side, when kind of assessing the risks, then I think the first risk that is worth stressing is the kind of disruptive effect that fintechs have, particularly on the traditional industry. Why? Because fintechs obviously also kind of focusing on the most profitable segments also of the traditional players. And hence, if you are competing more and more in the most profitable segments also of the traditional players, then there may be an issue relating to stability, which at the end of the day probably raises some concerns in terms of financial stability as a regulatory rationale. The other risk, and that is something that we have seen also in practice, is what we would kind of call fintegration, which is that we have seen already mergers of fintechs with some of the traditional players, which is very difficult also from a regulatory perspective, because in certain areas we have unregulated players and merging with regulated players, or there are certain differences from pure legal entity approaches where you can say, well, certain parts of the activities remain unregulated, others have to be will still be regulated, and that leads to obviously also topics that had been raised also in the previous session here, which is linked to risks, particularly operational risks, but also, and I think that was an excellent point at the end of the previous session, this kind of increased interconnectedness. Because when we just think of all the gadgets that we have in the area of fintechs, then it's fairly clear it doesn't really matter where we are with any kind of fintech application. We kind of interconnect people, players even more. So therefore, there's, I think, a significant regulatory challenge there. And also we are here in the banking session of this conference. I think we have to be fully aware that it's not only about banking, but also non-banking business. And with non-banking business, I clearly mean capital markets business. So first of all, what we see here is that fintechs clearly are disruptive. They are an alternative to some of the traditional banking services. But what remains clear so far from observing this development is that particularly in the banking side, but it also applies to a certain extent to capital markets regulation, is that the fundamental regulatory and legal concepts that we currently have, be it the Basel framework on the banking side, be it the MiFID framework on the capital market side, be it a solvency framework on the insurance side, they're really difficult to be applied to this kind of fintechs, and therefore, and I don't necessarily want to go into the deep details, but what we can observe so far is that is twofold. First of all, that fintechs either remain unregulated, simply due to the fact that many regulators don't really know how to treat them. And the other phenomenon that can be observed is that fintechs are not adequately regulated, and there are numerous examples out there. So, for example, if you just see it from a pure European perspective, it's completely unclear whether certain fintech activities would fall under the MiFID, the Market Abuse Directive, the Prospectus Regulation. For example, the ECB qualifies cryptocurrencies as e-money, which is not necessarily consistent with other regulators. When it comes to crowdfunding, then it's still a little bit unclear whether that would be covered by what we have seen, crowdfunding regulations at domestic level. Is there potentially also a clear link to traditional banking regulation? When it comes to virtual currencies, it's very difficult to link them to the MiFID framework, because at the end of the day, there is no real, at least in a traditional sense, issuer or no market manager. So there are tons of difficulties from a pure regulatory perspective. However, despite we have this complexity, I just want to extend it a little bit further, because fintech is very often used as this kind of, I would say, key definition out there to everything that is kind of linked to technological innovation. But I think we have to be a little bit more precise, because aside from fintechs, we also have so-called regtechs and also techfins. Regtechs are typically those players that are assisting regulatory processes through technology, typically following a top-down approach. So, for example, in the previous session, we had already references made to AnaCredit. We had made references, for example, to regulatory reporting, etc. So therefore, these kind of regtech companies are very useful, and at least also from my practical experience, from pure regulatory perspective, regulators are much more comfortable with this kind of regtechs, because at the end of the day, they are just assisting what is kind of reflected already in the current regulatory framework, and therefore the top-down approach that these guys are kind of following is also more compatible with the current regulatory environment. The challenge that is mostly left out so far in the discussion, however, the techfins, and these are, and we just had an intervention on credit rating agencies. I'm not necessarily referring exclusively to them, but I'm just referring in general to data vendors, where we have players in the market that have a certain data superiority, because they have been collecting so much data about the financial industry over the past couple of years, and hence they become important, at least from a market infrastructure perspective. And these techfins are, I would say, just vaguely reflected in this kind of regulatory discussion. So in order to kind of stimulate the discussion in this session, I just want to make 3 main points. So against the background of what I have kind of laid out, I think it is important to kind of specify about what animals we are talking about, but nevertheless, the clear development so far is that the distinction between fintechs, techfins, but also regtechs, as well as traditional banking institutions, will continue to get blurred and make future regulation even more difficult. In addition to that, what we also see is already a significant shift towards market consolidation. We see lots of M&A activities between traditional players, fintechs, techfins, and regtechs. And as I've already alluded to a little bit earlier, already this currently poses quite some regulatory challenges, and I think the challenge will become even bigger. And lastly, I think at the end of the day, we have the whole risk component that had been addressed already in other contexts as well. do we really reduce the risk in financial markets as a whole by, for example, transferring some of the activities to fintech, techfins, or regtechs? From my perspective, not necessarily, particularly if we kind of continue with the current approach, which is that most of these activities remain unregulated. So therefore, at least also for the discussion later on, my perspective is that the future regulatory capture of all these guys is actually the key challenge ahead, because if we are not able to master that, I guess we will end up in a super complex regulatory environment where we lack particularly consistency and coherence, and I think that is clearly then to the detriment of financial stability. Thank you.
Yeah, I think I agree with you. I think we've learned the lesson, or I hope we've learned the lesson with the previous financial crisis, where, if I can put it that way, the industry was running way ahead of the regulation with innovation. And then we've had all of these products that were very difficult to assess, very difficult to analyze, and very difficult to manage in terms of risk management. And I think now, even more so with the current situation with the COVID crisis, we really need to think of, as you've stated, how to manage, how to regulate, and how to have an oversight of what's really happening in the financial world. All of these innovations, I'm just hoping that the regulators will be able to keep the footsteps of what the industry is doing. Thank you for your input.
Exactly. Not everything that is fancy is good.
Exactly. No, but as long as I would say the regulatory framework is able to capture what's happening on the ground, I think we're safe. But we'll probably have to wait and see how it will unfold in the years to come. We have another lawyer on our panel. His name is Adrian Dumitrescu. He's a banking lawyer and a PhD candidate at the West University of Timisoara, Romania. He has 12 years of experience in the banking field, including banking regulation and supervision. He published a series of articles in the top legal journals in the UK on topics related to banking union, European Banking Authority, legal instruments of the European Central Bank, and the international monetary law. We've already kind of announced your topic several times today, which is AnaCredits. It's a project that is set up as a data set containing detailed information of individual banks in the Euro area, harmonized across all member states. The decision of the ECB was to go ahead with this, I think in 2014, if I'm not mistaken, and it requires 100 data points for each exposure larger than 250,000 euros. How do you see this project being useful for the industry?
Hello, thank you for having me here. I hope you hear me well. Indeed, in my presentation, I intended to focus more on the application of the benefits of the AnaCredit for the non-euro area, for the countries which are not part of the Eurozone, and to take this opportunity to signal the legal obstacles that would practically make the participation of these non-euro countries to this big project legally impossible. So just as a few background ideas, it's worth mentioning that this idea of this centralized infrastructure for collecting and sharing the granular credit risk data within the European banking sector, which is called Analytical Credit Data Set, took shape after the global financial crisis, aiming at developing a granular data set on credit risk covering all participating member states. So as you said, AnaCredit collects information on a loan-by-loan basis from credit registers operated by national central banks in the entire Europe and from any other granular data sources. In this way, AnaCredit was intended from the beginning almost to become one of the most extensive databases that ever existed. And it has a multitude of usage options in the supervisory process, off-site and on-site, and it permits analysis options that otherwise were not covered by regular reporting. This credit registry has been created primarily to satisfy the information needs for monetary policy, but it lends itself to be extremely useful for supervisory purposes, allowing a more detailed view on banks' loan portfolios, the possibility to segment the portfolios according to different criteria, and to perform drill downs from high-level harmonized reports into granular data. It also would permit a better monitoring of banks' progress in reducing NPLs. As regards the non-euro member states' accession to ANA credit, the first idea would be that this would be a benefit for enhancing the perspective of cross-border stress testing, which has been signaled recently in a report by the Bank of International Settlements. And theoretically, as regards the non-euro area, ANA credit should be open, and on a voluntary basis, these member states could participate, especially the member states which are part of the non-euro member states which are going to become part of the single supervisory mechanism, Bulgaria and Croatia. To this aim of allowing these non-euro zone countries to participate in this project, the ECB adopted a specific decision on the procedure to be followed in order to join, and which establishes the steps that these non-euro countries have to undertake. Of course, they have to express their interest, and the ECB would analyze the preconditions that it set out in this decision if they are fulfilled, and finally it would decide to recognize the interested member states that qualifying as participating member states in ANA credit. However, a few conditions from a pure legal perspective, a few preconditions that ECB established for these non-euro countries practically made the participation to be legally impossible. So whatever the benefits would have been, that would not come to reality. One of the preconditions is that established by this official ECB decision is that the national law of the non-euro member state has to incorporate specific provisions on the regulation, on the EU regulation on statistics, which specifically allows the European Central Bank to directly impose sanctions to reporting entities for not fulfilling the statistical reporting requirements. So in this way, the ECB requires the non-euro member states to incorporate this in national legislation this power of the European Central Bank to directly imposing fines or other sanctions directly on the reporting agents which are located in non-euro member states. This, from a legal perspective, comes in total contradiction with other provisions of the Treaty on the Functioning of the European Union, which specifically stipulates that the ECB cannot have directly applicable powers over the entities, whatever entities established in the non-euro member states. This comes from Article 139 and 132 regarding the fact for the treaty regarding the fact that the acts of the ECB cannot apply to non-euro member states. So it becomes clear that on one hand, these member states have to respect the treaty, and on other hand, they have to fulfill and to abide by this ECB decision if they want to join ANA credit project. Another legal aspect would be that even if a non-euro member state would voluntarily wish to abide by this ECB decision and to provide the ECB with the powers to apply sanctions in its jurisdiction, this would still not be possible until the provision of the treaty, which provides that the competences of the European institution cannot be conferred by the national legislations of the member states. Therefore, a first idea is that the non-euro member states cannot amend their national legislation so that to give the ECB the powers that the treaty explicitly prohibits for the ECB to have. Another main idea from the legal perspective is that Another precondition that the ECB requires from the non-euro countries is that the member state should ensure by national legislation that the central bank is obliged to follow any ECB specific guidelines, requests, or measures related to ANA credit related issues. Apparently, this would be legitimate expectations for legal certainty from the ECB to require. However, this again could not be fulfilled by a non-euro member state due to the fact that it is obliged by the treaty that the central bank remains independent from any European Union institution, including the ECB. And this is because the non-euro central banks are not subject to mandatory guidelines or instructions from the ECB. As I mentioned before, the ECB legal act cannot have a binding effect on non-euro member states, including their central banks. So against this backdrop, again, the national legislation of a non-euro member state, even if the non-euro member state would want to adopt it, would have big problems of constitutionality versus vis-a-vis these explicit prohibitions of the treaty. So this is the main idea. These are the main ideas that I wanted to point out. And just to mention that the forthcoming accession of the Croatia and Bulgaria to the single supervisory mechanism would not remove, in respect of these countries, these legal obstacles, because these countries would still remain non-euro countries until the final adoption of the euro. So I take this opportunity to signal the necessity of an immediate amendment of this ECB decision, because I know from practice that several non-euro countries would like to join this ECB project, but from a legal perspective, it is necessary that this procedure is amended. Thank you.
Thank you very much. We did have a representative of the Croatian National Bank in our first panel this morning. Too bad we don't still have her here, so maybe we could hear from the first hand what is her standpoint in this. But thank you so much for bringing this up. I think it's a valid point that these two countries you've mentioned would need to see how they would go about this project mandated by the European Central Bank. Yeah. Thank you so much.
Thank you.
Next up, we have Dr. Guan Seng Ko, who is the APAC advisor at Kamakura Corporation, and also he's an adjunct lecturer at the Singapore Management University in Singapore. As you can see, we have panelists from all around the world. He has over 28 years of experience in design and implementation of enterprise-wide investment, banking, and risk management models, systems, and processes. He has gained deep practical insight from careers spanning across financial institutions in USA, Canada, UK, Singapore, including Man Group, where he was a principal scientist designing and running the algorithmic AI based hedge fund. And then American Bourses Corporation, which included robo-based analytical solutions and financial info utilities to traders and investors in US and North Asia. At Atos Origin, RHB Capital, where he was a group CRO, Singapore Exchange, Standard Chartered Bank, where he was a global head of risk analytics, and many other institutions. He holds a PhD in computational physics from the National University in Singapore, with a postdoc R&D in AI-based data mining, computer-aided drug design, material science, and financial market applications in Japan and America. I hope you can hear us well, Dr. Ko.
Good day to all of you. Can you hear me?
Yes, we can hear and see you well.
Oh, thank you very much. Thank you very much. Good day to all of you. Thanks for inviting me to this panel. I will provide a slightly different perspective because my exposure is currently more in the emerging markets. And if the previous speakers have mentioned about the fintech companies, here I would say that in terms of the fundamental raw material needed to harness the digital environment, you probably need to look at the raw materials first, basically the data. But we operate in a region where the big tech or the tech fin companies could actually pose great challenges to the traditional banking system because they have enough capital, the likes of Ant Financial or Tencent WeChat, which is like a super app. And the profile of the people in this region is very different because most of their smart mobile devices is actually very miniature. Most of their access is through the smartphones, not the laptops, not the tablets or whatever. So the phone become a very initial captive entry point for all things digital, whether it's for banking, whether it's for private banking, wealth management, or whatever. At the same time, the kind of challenges that most of the digital banks face, together with the regulators, is that there's a more massive use of alternative data, which is hardly mentioned. So, like in the case of the value of data itself, all models, whether it's for regulatory reporting, money laundering, fraud detection, the issue of data is the most critical. If there's no data, there's no risk model. If there's no data, there's no AI or machine learning model as well. And at the same time, if we are talking about data, the aspects of data, whether good or bad, will play a major part as well. Bad data means your model is bad, right? And that has given to the ethical issue of whether the new kind of models being adopted in this digital environment, whether using AI or machine learning, are they ethical, are they fair, transparent? Now, if you are using alternative data, it has a lot of impact on ESG data or climate change disclosure. So it was very nice to hear from the other speakers regarding the kind of situation we have right now in terms of the stress crisis. But a lot of times, the current ratings model that are provided by the vendors like MSCI, Morningstar, they are still based on the 20-year-old model of ESG, which is basically using only mainstream data, not even alternative data. But in today's world, with so many types of alternative data, the impact of ESG and climate change is not, some of them could be very point in time, like a hurricane or like a natural disaster, but most of the time, the climate change effect will be either medium or long term. It's not something that you really measure within an annual, based on an annual performance or things like that. You have to track them, monitor them, and then actually assess the impact over the medium term or longer term. So in Basel, we have a criteria for specialized lending called specialized lending for project and infrastructure financing. I used to work for firms that invest in infrastructure like airports, railways, shipping ports and things like that. If you look at all this kind of lending, whether it's responsible or whatever, they can be impacted by climate changes. And at the same time, the transition risks from the traditional energy sector that banks loan out to, say the oil and gas sector, with the transition towards climate change, there could be a movement towards the cleaner and green energy. But a lot of these idiosyncratic emerging markets, especially where their wealth comes from the oil and gas sector, they obviously will be impacted. And that would impact on the capital adequacy of the banking system, and it can be systemic. So all the countries around the world, if we are talking about climate change or ESG, they are all at different maturity levels. So while the impact can be globally systemic, the idiosyncratic effect can be disastrous according to the level of climate dependence that the environment has. And it will have a contagion impact on the financial markets and the banking markets as well. So a lot of issues arise, and I think we still have a lot to think about in terms of the modeling aspect. And at the same time, understand that we should have the governance in place first at the foundational level. So I think this conference has been interesting for me because you hear insights from various parties with regards to their interests, but at the same time, the availability of the data and the alternative dimension, whether it's structured or unstructured data, will also play a part. So, and today the whole world is looking for talent. in terms of harnessing all this data. And going back to the example of the big tech companies, if you look at Ant Financial or WeChat or say M-Pesa in Africa, most of their ecosystem has a sub-ecosystem within them. So they are doing everything like a typical global trading house like Louis Dreyfus or say Archer Daniel Midlands or Bunch or whatever. That means they have a view of all the activities, corporate and retail based, right at the beginning of the life cycle upstream, downstream, right down to the end, the customer level. So from data hosting, production, to the analytics, the aggregation, the centralization, and then downstream to the personalization to each segment of their customers. The current digital challenges, the fintech companies that globally you see in the developed world, they tend to be more focused on the retail market. In Asia Pacific, it's very different. Their application area and their challenge actually extend through the whole life cycle from the high net worth customer, the retail market, as well as the corporate market. So whether it's in supply chain or things like that. So you see that the kind of challenges posed in the digital world is very different. And the understanding of the data available, the integrity and things like that becomes more important. So there's a reason why I decided to talk on data and the data value because of this emphasis and the idiosyncratic aspect of the markets in the EM world and the frontier markets, say in Africa or whatever. Okay, so I think I've spoken enough, so we can leave it to the audience to ask questions later on if they have. Plus time for the next speaker. Thank you very much.
Thank you indeed. I do have one more question for you before we move on to the last speaker for today. Banking sector, you're very familiar with the whole infrastructure. Maybe one of the leading sectors in terms of innovation over the last years, whether we like that or not. And that innovation, in my view, comes in both front and back of the bank. If you observe an average bank that is striving to be a bank of the future, what is really the key success factor to in this innovation-driven world or data-driven world, as you've mentioned? What are the key milestones or key points that an average bank would need to look at to really be competitive in the future, not only in terms of competing with other, as you've said, fintechs or other financial institutions, but also with market shocks like the one we have today?
In most countries, I think the regulators have given leeway to the fintech companies or digital banks to innovate first without imposing the harsher and rigorous stress testing, liquidity requirements or capital adequacy requirements. If a digital bank is to succeed, what they need to do is to kind of build up from the basic foundation of what a banking model is. So they have to have an enterprise view of their asset balance sheet, their asset liability profile, their cash flow profile, and trace all this data right up to the account level or the cash flow level so that they have an integrated view of all the moving parts in their ecosystem. So I would say that other than the raw materials, your data, which is centralized, they also must have a way to analyze all this data that's collected and aggregated in various forms and make use of technology to standardize them so that they can trace backwards to the origin or to the lineage of the data. Number two, the enterprise view of everything is very important. Hence, the challenge with setting up an enterprise ecosystem view of the risk exposure. So it can be on your liquidity at the total level. It could be your leverage at the portfolio level, or it could be in terms of the various sub-portfolios when you're looking forward in terms of scenario analysis or stress test or subjecting it to a perfect storm environment like today. I mean, and plus, of course, with the climate change requirement going forward, you need to rethink about a stress test requirement for a green swan event. A green swan in the sense that the climate change could actually impact on the current profile of the bank's sustainability and things like that. So I would say that the enterprise ecosystem view, plus the life cycle perspective, and the foundational strength of your data requirements. Overlaid by a very good cybersecurity system, of course, because the whole world is, the cyber risk will keep on be around for, say, 1 or 2 generations. Yes.
Right. I do hope, or we do hope, that the green swan in this case beats the black swan.
Yeah.
Yeah, and I'm glad that you mentioned the cybersecurity perspective of it, because as much as the innovation grows, that's how, at least to the same extent, the risks of data protection and all the other matters that are important in these terms are growing as well. Thank you so much for your inputs. Last but not the least, today we have Mr. Calvin Jill, who is a regulatory consultant with over 20 years of experience in the field of financial services, regulation, and risk management, including a prudential policy maker for the Bank of England and FSA, a regulatory consultant for EY, and an in-house regulatory capital and liquidity advisor at Credit Suisse, Morgan Stanley, Nomura, Wells Fargo, and some other institutions as well. He's helped Insight develop RegTech solutions, including different types of solutions, and some of these he's going to talk about today. Mr. Jill, can you hear us?
I can. Can you hear me clearly?
Yeah, we can hear you clearly. Mr. Jill, you've taken an active part in building web-based software as a service, as we call them, SaaS, applications for different banks and firms in UK. These software are used in banking industry. They must meet some regulatory requirements, but also comply with all the regulatory requirements of the governing sector as well. Can you share with our audience what have you learned from your experience implementing such solutions in the financial world? What are the key takeaways? What is your main takeaway from your experience?
Excellent. Okay, so I've been a regulatory consultant now for about 6 years, and we advise all sorts of banks, investment firms, fintechs, and so on. And I think where we come at things from is that between us, my partner and my business partner and I, we have about 50 years experience in financial regulation. So I will share my screen and that will work. So does that work? Can you see a PowerPoint?
Yes, we can see it.
Okay, excellent. So basically, Leslie's background is as a compliance officer. So she was most recently head of compliance at Bank of America Merrill Lynch. And my background is very much in the sort of whole prudential liquidity recovery planning area. And we both sort of meet up in the area of governance. So yeah, that's our sort of normal day job in terms of providing advice to clients, helping them deal with regulatory issues. And what we've decided as well is that actually we can use our experience, because the tech is there now, to actually build really useful tools to help people do their job. So we come at it very much from the point of view of what would we want from a tool if we were still working in-house. And that's the insight we try and bring to it. And what we ended up building initially was a tool called Cerberus, and that was basically for the UK's senior management and certification regime, which is their individual accountability regime that has come in post the financial crisis in 2008, where what they want banks and firms to do is basically identify who does what in an organization. So, obviously post-crisis, there was a lot of, there was no individual that went to jail, or, very few people went to jail for, what was a massive failing in governance. And so we built that for the UK with very much, I suppose, the UK regime in mind. But, individual accountability regimes are spreading out around the world. And, in time, we hope to adapt Cerberus for those regimes. So you've got, in Asia Pacific, in Hong Kong and Singapore, in Australia, there are individual accountability regimes. In the EU, you can see, in the EBA's risk management and governance frameworks, you can see that the same kind of things coming through. So we built a tool for individuals to be able to evidence that they're meeting their reasonable steps when they're carrying out their statutory duties. So that if the regulator ever came in again and said, okay, who was doing what and who was responsible for what, Cerberus is something that would allow them to evidence that. So we can evidence delegation of responsibilities, and if I delegate something to Denny, he would either have to accept or reject, and that's kind of shown in the system. So basically, you can show an entire senior management structure, but it's very much, it will only work if those senior managers use it. So they've got to take that individual responsibility and actually use the tool. They can't just leave it to their secretary to do. And ultimately, what we're trying to do is save people time and money. That not only is it an effective tool to evidence what they're doing, but at the end of the day, it will save them time and money from, instead of completing a spreadsheet or a database, it's kind of there on their system, on their iPad, and they can do it. And we've also recently we built a culture and conduct assessment tool, and we've partnered with a training company and people with a sort of psychology background, and that's basically to help people assess where their culture is, and we're going to be launching that soon. And that's kind of basically the two tools that we've built at the moment. We're also looking at other things around reg reporting, particularly for the investment firm regulation that's going to be coming in the next year or so, and just general risk MI for firms. But in terms of what have we learned? I mean, basically, whatever, I would absolutely encourage anyone who's got a good idea to investigate the possibility of building an application, because, we've done it over the last 2 years and we've had a lot of fun doing it, but it's a lot of hard work. It's going to take you longer than you think. It's going to take up more time than you think it will, and it's going to cost you more than you originally think. And, obviously, at the moment, FinTech, RegTech, TechFin, they're all sort of big buzzwords. Within every regulator's got a sandbox. Every bank has got an innovation hub or an accelerator. But I think when it comes to actually selling it to the end users, what we find is that it's quite hard. So you've got, there's a lot of time that you need to take in order to sort of show people how you can help them, how it can make their day-to-day lives easier, because they've got their day-to-day jobs to do rather than just meeting people who are selling them something. But I think it's very much the future where if you've got experience and knowledge and you can ally that to some kind of technology, whatever it is, and build something that actually helps people, I think people will want it. And hopefully we've got some good clients now, and where we've got something to build on. In terms of what have we learned in the last couple of years? Our view was very much, anyone can have a good idea, but the key is to have something to show and tell people. So if you can, get beyond that proof of concept stage and build a minimum viable product that you can demonstrate how what you're proposing actually works, then it's much easier to sell that into banks or firms, because they can then use it and play around with it. It takes a lot of time and you've got to go out and meet a lot of people, because we're not technical people. So we obviously had to find people who could do the coding for us, and that is quite key, that the people that can do that for you actually, they understand what you're trying to do, and then you give them enough detail that they can actually build what you want. So we've been very lucky in that we found a really good company that's UK based, although all their coders and developers are in Russia. But what we've learned is that coders love rules as well. So we can give people a set of rules, and they can go away and they can build what we want. From a technology perspective, obviously there's lots of good technology out there, and the big, I've put in here, do all roads lead to Amazon Web Services, and I think what we found is that actually, companies like Amazon Web Services, Microsoft Azure, and Google, they are very much the road. And I use Amazon Web Services in particular because we have experience of dealing with them, and the technology they have on offer is amazing. So in terms of AI, we were originally dealing with a small company in Israel, and they were very good, but because they were small, it was, could they give us the attention that we needed? And then when we met with the Amazon guys, we found that actually their technology was pretty much there, and it was a lot cheaper. So it's kind of very difficult to avoid these large tech companies, although you can do it. We're not using AWS at the moment, but at some point in the future, I'm sure we will, because what we've also found is that clients want to have these kind of names that they're using. So, I think they like the idea that you're using AWS because they think it's more secure, more stable, and so on. Not that there aren't alternatives, but, it's very difficult to avoid them. Moving on to funding and, ultimately selling and pricing your product. We self-funded Cerberus, and so we tried to build a model whereby we built something, we go out and get clients, and then the payments that the clients make for it, the subscription that the clients give us pays for feature development and improvement. Just a personal observation is that you can spend all your time chasing funding, and I kind of think it's sometimes at the expense of developing your product. Although you might, if you get funding, you could say, well, we can pay people to do that. But then it's almost as though chasing the funding becomes your job rather than actually building a product and a business. On the pricing side, we think we have a much better product than our competitors do, and we think it does more than what they do. But actually, your competitors are competitive, so and clients are often will be unwilling to pay a premium, especially for a startup. So you kind of have to price accordingly, and it is very much, you kind of have to make it up as you go along. Looking at, obviously there are a lot of regulatory sandboxes around the world now, and there's a global network of them. But there's also, banks have innovation hubs and accelerators, and again, you can spend a lot of time trying to get into these things. And I've seen other companies that we know, they spend a lot of time going from one accelerator to another, and again, that can become your existence. But you really have to move your product along, and if it helps you do that, that's fine. But it does take up a lot of time. On the regulatory sandbox front, I would say the FCA in the UK has a very good and a very well publicised sandbox. But I think what my view is that the companies that go into it are kind of established already. They're not really startups. And being a bit cynical, it looks as though it's an exercise in mutual backslapping of, the regulators can say, oh, we're sort of, we've got our finger on the pulse of what's going on out there, which is good. And then, the companies that go in can sort of say, oh, look, even though the FCA don't approve you, we got into the sandbox, and it becomes like a badge of honor. I mean, for us, we haven't gone down that route. We've just kind of focused on building the product and getting it out to clients. So, I mean, with Cerberus, we kind of did it very much on our own with our coders and developers. And I think the key thing we've learned now is that actually to get things moving quicker and to scale up quicker and get a more, a more finished product, you actually have to go out and find good partners. And, certainly the time that we've put into, meeting people, having coffees with them, we've now got a good network of, other companies that we can work with, whether that's other consultancies or other tech companies. But also we've got direct contacts with banks and investment firms, so that, we can say to them, you might not want to build something internally because your internal IT costs are much higher than perhaps if you outsource to us. We could build a minimum viable product for you and then partner with you in either sort of you guys taking it on or taking a share as we build another business. But I think that's the key thing, that you've got to have good people working with you to actually build that successful business, because you can get it started, but actually to really grow it and establish it is the hard part, and that's why like good partners is the key. I mean, that's pretty much what I had to say. So I hope that's been interesting.
Thank you. Yeah, thank you very much. It's been very interesting to hear from the first hand how this process of walking out of the industry itself and then still being connected to it by providing innovative solutions. That's very insightful. Now, it's been a very, very long but a very, very enriching day, I would say. We've had so many interesting panelists. We've had so many interesting conclusions. Within the conference, we'll try to have some kind of a proceeding out of this with all the wonderful suggestions that all the panelists have had for different levels of regulators and institutions themselves. Just before we finish, we do have one question from the audience that I would like to bring to the floor. It says, what is your view on the best possible way to establish the innovation mechanism within central banks? I think it's a very valid question. We've discussed regulators, we've discussed institutions, but now we have a question regarding the central banks and how they would bring the innovation on the floor. I don't know, maybe Dr. Ko, or if anybody else would like to address this question, would be more than happy to take that. Dr. Ko, would you like to try to give a response to our audience?
Sure. Are you familiar with the twin identity in the cyber world? The twin identity. So the central bank could create a virtual carbon copy of themselves, but in the virtual twin environment. That means it's a replica, like a hologram or like a 3D
avatar.
Avatar, like a virtual reality structure. And a lot of this kind of innovation can be experimented first in the virtual world, either using augmented reality or virtual reality, And I believe that today the technology has progressed enough for us to simulate our avatar in the regulatory world. So once you have that, you try it in your augmented reality, and then you have a fair idea of what are the scenarios you're looking at, the innovation that you are trying out, how it affects the ecosystem of that avatar, and then put it into practice in a real physical world, maybe in a smaller sandbox environment first. And once that testing, whether it's based on backtesting of the data you have or collected, or some simulated data going forward like today's crisis, then it's possible to think of all the various innovation. But of course, the person who designed the avatar must be very conversant with the business model first. It cannot just be a data scientist with a lack of experience or something. So if you look at the ratings agencies today, right, they tend to be very static. But at Kamakura, we have used a PD model instead, which is updated daily, where we use a multi-model approach. So the model can come from the business cycle or macroeconomic factors. We combine it with the market factors. We combine it with the idiosyncratic company data, including the management turnover and things like that, plus the adverse news. And then potentially you'll be able to kind of model that on a dynamic basis, more having fluctuations in the probability of default compared to the ratings model that comes from the S&P or Moody's, which tend to be very equity market centric or backward looking. So that give you a different dimension than what you're looking at. At the same time, during our hedge fund days, we were actually looking at the same risk metrics across different time horizon, across 1 minute tick data, hourly tick data, daily tick data, half yearly tick data. And you'll find that even if you are measuring the same metrics, they actually vary across this temporal time-based market structure. And some of them, which are short-term signals, could provide an early warning with regards to certain trend or credit deterioration or whatever. So I think the modeler for the avatar would be very, very important. He must have the business knowledge to look at the regulatory expectations, but at the same time, coming from the sell side, the banks, he must also know what the regulators want to look for in that kind of virtual environment. Yeah. So that's my immediate idea that came to me to looking at the question. So
that's a fantastic idea. I think we can all embed that into our not only professional but also personal lives to try to test things on an avatar first before we move on into the implementation stage. Thank you so much. As I started saying, so we've had a day full of very interesting insights. We've had 3 panels. The first panel looked at the prudential regulation and what is the future of regulation. Second panel looked at Basel III implementation, stress testing, rating models, and how that is to be implemented into the future. And our last panel, which we had just now, was looking at the future of banking and sustainability, at innovation, and how a bank in the future should and could look like. I'm just seeing that on our chat box is becoming crowded. We have another question coming from the audience. I'm just going to read it out loud. The last minute to finish it off is: how much do you believe that data visualization is going to be important in the next period for the banking and the finance sector? So data visualization and how important, how present will that be in the banking sector? If anybody would like to, it wasn't addressed directly to anybody, but if any of the panel members would like to address that question, please feel free.
Well, I can do it as I'm speaking. I think the answer is straightforward. It's going to be super important, and just kind of linking it to the previous answer. I mean, I'm currently involved in a little bit of a RegTech sandbox exercise with both a central bank as well as the financial regulator, and it's all about data visualization, etc. So that will clearly be the future. That's why I also like Dr. Koh's idea of the avatar. To a certain extent, that's what we're also conducting in the project that I've mentioned. And at the end of the day, data will be the big efficiency gain. So the challenge that I see, however, is do we have sufficient trust in all this kind of data-driven future environment? From my experience, financial regulators are showing at least a certain tendency that they're willing to learn and willing to catch up with that. Whereas on the side of the central banks, I rather witness a certain degree of hesitation because, as we all know, central bankers are not necessarily the most innovative guys on this earth.
Yes, indeed. Thank you, Armin, very much for that answer. I hope that satisfies our viewer with the question, and I want to thank all of those who've been with us today, who stayed with us. I'd like to thank our panel members for taking the time to being with this conference, and we look forward to seeing you again. Do not forget that conference continues tomorrow with capital markets, and after tomorrow, another innovation-related session. I'd like to thank all of those people who were attending this session today. I see that some of those are my previous students as well. I'm very happy to see them here too. And with this, I'd like to conclude today's session and looking forward to seeing all of you in some other venue, in some other occasion. Thank you all so much, and see you all tomorrow.
Thank you.